2026, two jurisdictions are drawing the largest concentration of mobile capital in recorded history. One operates under a constitutional zero-tax framework, anchored by sovereign wealth reserves and permanent infrastructure investment that no legislative cycle can unilaterally reverse. The other has rebuilt its flagship residency program from the ground up following years of sustained legislative erosion under compounding OECD enforcement pressure. The United Arab Emirates and Portugal are not competing on identical terms. They are competing on fundamentally different architectures. And if you are a high net worth entrepreneur, a family office principal, or a mobile capital holder making a jurisdictional decision in 2026, the question you need to be asking is not which country offers a lower headline tax rate today. The operative question, the one that determines whether your structure survives intact in 2030, in 2033, and 2035, is which legal and fiscal architecture was built to endure. This episode provides a data-driven, compliance-aware comparative analysis of both jurisdictions. We will cover corporate and personal tax frameworks, economic substance requirements and their true costs, CRS and DAC 6, exposure risk, treaty network depth, and the single most important date on the international tax calendar for any structure currently anchored to Portugal, the 2027 IFICI mandatory review. The UAE's Federal Decree Law number 47 of 2022 established a corporate tax rate of 9% on profits exceeding AED 375,000, approximately $102,000 at current exchange rates as of Q1 2026. Below that threshold, the rate remains zero. For qualifying free zone entities that meet the substantive activity requirements under the economic substance regulations, a 0% corporate rate continues to apply to qualifying income. Personal income tax in the UAE is constitutionally absent. This is not a temporary policy exemption, and it is not a discretionary concession that a minister can reverse by gazette notice. The UAE federal constitution does not permit the imposition of a personal income tax. This constitutional architecture is the single most important differentiating factor in any serious comparative analysis, and it is the factor most frequently underweighted by advisors operating primarily within European regulatory frameworks. Portugal's non-habitual resident program, the original NHR, ran from 2009 through 2023 and offered broadly structured tax exemptions for foreign source income during a 10-year residency window. The program generated substantial inflows of mobile professionals and capital holders from across the EU, the UK, and increasingly from Brazil, the United States, and South Africa. Under sustained OECD and EU enforcement pressure, and following concerns raised in the context of the 2023 FATF mutual evaluation process, Portugal enacted the successor framework, the IFICI regime through Budget Law 2024. NHR 2.0 imposes a flat 20% rate on qualifying Portuguese-sourced income. For passive capital holders, those deriving income from foreign dividends, royalties, or offshore real estate, the new compliance thresholds introduced under IFICI represent a material reduction in tax efficiency compared to the original regime that many existing structures were built to rely upon. Establishing genuine economic substance in the UAE is not optional for tax compliance purposes. It is structurally mandated by the UAE's economic substance regulations, first introduced in 2019 and subsequently aligned with OECD BEPS Action 5. A verifiable local office, a resident directorship, and an auditable payroll arrangement are the minimum qualifying criteria for maintaining free zone zero rate eligibility and for defending the structure against substance challenges under CRS or BEPS review. The annual all-in cost for a compliant Dubai free zone structure ranges from $18,000 at the lower bound to $42,000 at the upper bound, depending on zone classification, licensing category, the scale and seniority of the directorship arrangement, and whether the payroll component is satisfied through a genuine local hire or through a service arrangement with a licensed professional employer organization. These costs are fixed, quantifiable, and do not carry open-ended penalty exposure. They are the price of a defensible, jurisdiction-proof structure. Breaking that cost down, Free zone licensing runs between $5,500 and $12,000 annually, depending on the zone. DFC, ADGM, DMCC, and Dubai Silicon Oasis each carry distinct cost profiles and activity permissions. A verifiable office, which must be a physical workspace and not merely a FlexiDesk nominal address for substance purposes, adds $8,000 to $18,000 in Dubai's current commercial leasing market. A resident director arrangement adds $4,000 to $8,000. Minimum payroll to satisfy ESR auditable employment criteria costs $6,000 to $12,000 annually for a basic administrative or operational role. Portugal's NHR 2.0 imposes no formal substance test on its residency applicants. A qualifying individual need not demonstrate a local office, a local directorship, or local payroll. This appears on the surface to make Portugal structurally cheaper to establish within. The appearance is misleading. EU mandatory disclosure rules under DAC 6, the EU Directive on Administrative Cooperation, require that any cross-border arrangement displaying specified hallmarks of tax planning be reported to the competent tax authority. For NHR 2.0 registrants maintaining offshore accounts, foreign corporate structures, or passive holding arrangements in non-EU jurisdictions, the DAC 6 hallmarks under Category C and Category D are engaged. Compliance advisory costs for DAC 6 reporting and ongoing structural defense in Portugal run between $4,000 and $9,000 annually, and that figure represents the advisory cost alone, not any penalty exposure that arises if a challenge succeeds. Portugal operates within the OECD's Common Reporting Standard Framework and is a full signatory to the BEPS multilateral instrument. These are not abstract treaty commitments. They have operational consequences for every NHR 2.0 registrant maintaining offshore accounts, foreign corporate structures, or passive holding arrangements. Automatic information exchange between Portuguese tax authorities and the prior jurisdiction of fiscal residence is not discretionary, it is mandatory, and it operates on an annual cycle. The UAE has also signed the CRS framework. However, enforcement transmission from the UAE remains structurally limited by a fundamental architectural fact. The UAE has no personal income tax base. There is no domestic fiscal incentive for the UAE Federal Tax Authority to invest in granular individual data transmission on income flows that are non-taxable within the jurisdiction. This creates an asymmetric compliance posture that systematically favors capital preservation for structures anchored in the UAE relative to EU-registered alternatives. The 2023 FATF grade listing of Portugal is also a live variable for any practitioner building a compliance risk assessment. Although Portugal was not fully listed and subsequently took corrective measures, the grey listing designation triggered enhanced due diligence requirements from correspondent banking institutions and created documentary burdens for corporate structures registered in Portugal that have not been fully resolved in the post-NHR 2.0 transition period. Here is what most relocation advisors and residency consultants will not tell you directly, because it reduces the addressable market for their Portuguese services. Portugal's NHR 2.0 was not designed primarily as a wealth attraction instrument. It was architecturally designed to retain European political capital, to allow Portugal to maintain a competitive residency offer while satisfying the OECD enforcement pressure that followed the documented concerns raised in the context of the 2023 FATF mutual evaluation process. The program is operationally functional. Thousands of applicants will qualify and register without incident. Many will receive genuine tax benefits for 10 years and will exit the program in good standing. We are not arguing that NHR 2.0 is without utility. We are making a structural observation that is rarely stated clearly. It is architecturally constrained by the legislative and treaty obligations of European Union membership in a way that the UAE's framework is not, cannot be, and by constitutional design will never be. Portugal cannot offer what the UAE offers, not because of political will, because of structural geometry. The divergence between these two jurisdictions is not cyclical. It will not reverse when a new government takes office in Lisbon or when the OECD relaxes its enforcement posture. It is embedded in the legal architecture of each jurisdiction. The strategic decision matrix for a principal making a 10-year jurisdictional commitment extends well beyond the headline personal tax rate. Treaty network depth, sovereign stability indices, banking system resilience, and jurisdictional neutrality in geopolitical terms are each independently material to the structural soundness of any holding arrangement or family office domicile. The UAE maintains double taxation agreements with over 137 countries as of 2025. This network includes key treaty provisions covering dividends, royalties, and capital gains that are directly relevant to mobile entrepreneurs operating multi-jurisdictional intellectual property structures, royalty-generating entities, or diversified holding architectures. Treaty-based withholding rate reductions on dividend flows from operating subsidiaries in India, the UK, European jurisdictions, and Southeast Asia represent genuine, quantifiable value for the correctly structured UAE-anchored holding arrangements. Portugal's treaty network covers 79 active bilateral agreements. This is a substantive network by international standards, and it includes many of the same jurisdictions covered by UAE agreements. However, several of Portugal's treaties are currently under renegotiation following the NHR 2.0 transition, and the renegotiation process introduces counterparty uncertainty. A bilateral tax planner building a 10-year model projection for a Portuguese domiciled structure must price that treaty uncertainty into the structural analysis, uncertainty that does not exist in the UAE context. And on sovereign infrastructure, the IMF's 2025 Sovereign Stability Index positions the UAE as a Tier 1 jurisdiction. The Abu Dhabi Investment Authority manages estimated assets of approximately $993 billion as of 2024, providing the Emirate with a sovereign buffer that is structurally unmatched among comparably sized jurisdictions. The UAE ranks fourth globally on the World Economic Forum's Infrastructure Quality Index for 2025. These are not lifestyle metrics. For a principal making a permanent or long-term domicile decision, jurisdictional permanence and institutional resilience are direct inputs to risk-adjusted return on structural investment. The OECD's Pillar 2 Global Minimum Tax Framework establishes a floor of 15% on the consolidated profits of large multinational groups. The scope threshold is €750 million in consolidated annual revenue. For individual entrepreneurs operating single entity structures, family offices managing private wealth, and operating businesses below that consolidated revenue threshold, both the UAE and Portugal retain significant residual planning utility under the current international framework. Pillar 2 does not eliminate the planning differential between these two jurisdictions for sub-threshold structures. The critical divergence point arrives in 2027. Portugal's IFICI framework contains a mandatory review clause, Article 58 of the applicable budget law, which triggers a parliamentary reassessment of the NHR 2.0 program terms. That reassessment carries no predetermined outcome. A change in government composition, a shift in coalition priorities, renewed OECD or European Commission pressure, or a further deterioration in Portugal's FATF compliance posture could each independently drive a material adverse modification of the program terms. There is no legislative backstop preventing such a modification. There is no constitutional flaw protecting the current 20% rate from upward adjustment. Structures anchored to UAE residency carry no equivalent legislative sunset risk. The constitutional basis of the UAE's zero personal income tax framework is not subject to a parliamentary review cycle. There is no IFICI Article 58 equivalent. There is no scheduled reassessment date. The planning certainty that provides to a principal modeling capital flows on a 10-year horizon is not a minor footnote in the comparative analysis. For capital operating at scale and across jurisdictions, it is the primary variable. The analytical conclusion is not that Portugal is without utility. It is that the utility of a Portuguese NHR 2.0 structure is bounded in a way that the utility of a UAE anchored structure is not. For principals whose planning horizon extends beyond 2027, and whose structure depends on the continuation of specific NHR 2.0 terms for its tax efficiency. The 2027 review clause represents an unpriced legislative risk that belongs in every structural model. In episode 5, we will apply a parallel analytical framework to the exit cost architecture of Canada and Australia, two jurisdictions whose deemed disposition regimes and departure tax structures represent some of the most punitive exit mechanics in the OECD. If you are a Canadian or Australian national, currently modeling a clean jurisdictional exit strategy, episode 5 provides a technical framework you need. Subscribe now and activate notifications so you do not miss the data when it publishes. Join our community of informed investors to stay ahead. This data is for education and is not financial advice. Always consult a professional before investing. To speak with one of our specialists, click the link in the description. I'll see you in the next report.